So I would bet that the first thing most people think about when they hear value investing is actually the investing legend Warren Buffett himself. And to his credit, one of the most enduring ideas he's helped popularize is this concept called an economic moat. So it might sound fancy at first, but at its core, it's simply a durable competitive advantage. Basically, explaining why this company will continue to win. So this clip from the year 2000 still carries a lot of weight in the investment community today. In fact, you'll find the term moat being plastered across almost every value-oriented investor's website. And here's what Warren Buffett had to say about it.
The number one question you want to ask yourself is whether the competitive advantage has been made stronger and more durable before it, and that's more important than the P&L for a given year. So I would suggest that you read anything that you find that's helpful, or actually the best way to do it is study the people that have achieved that and ask yourself how they did it and why they did it. I mean, why is it that in razor blades, everybody grows up in business school hearing that as a great example of a product that's very profitable, and why, with it obvious that there's going to be no reduction in demand for the next 100 years for the product, why are there no new entrants into the field? What is it that gives you that moat around the razor blade business? Normally, if you got a profitable business, a dozen people want to go into it. If you've got a dress shop here in town and it looks like it's doing well, a couple of other people are going to want to open up a shop next door to it. And here's a worldwide business. Nothing can go wrong with the demand to speak of, and yet people don't go into it. So we like to ask ourselves questions like that, and we focus on that. Charlie?
Factors. Every business tries to turn this year's success into next year's greater success, and they all use pretty much every advantage they have in every direction from this year to make next year's better.
And truth be told, it's hard to disagree with anything he said. A strong moat really is the holy grail of long-term investing. But here's where things get even more interesting. Sometimes I wonder if the term has lost its meaning from overuse. And these days, it feels like investors are more afraid that others won't know that they know about economic moat more than whether the business actually has one. So it's essentially become some sort of a checkbox exercise of whether does company ABC have a brand moat, a cost advantage, or a network effect. And then investors just move on without asking the deeper question. Is this business actually getting stronger over time? So this video is sponsored by Longbridge, a MAS licensed broker in Singapore that's integrated a really powerful tool called Pot AI, built specifically for investors. So Pot AI helps you break down company announcements, summarize financial reports, and even lets you chat with it to dive deeper into any stock, from key metrics to valuation insights. So it's like having a research analyst, but way faster and available 24/7. And right now, Longbridge is running an exclusive promotion for new users in Singapore. You'll get lifetime commission-free trading for US, Hong Kong, and Singapore stocks. And if you deposit just 2,000 Singapore dollars, you'll receive a 0 platform fee coupon and a 6% per annum interest boost for 90 days. Even better, at the base tier, if you maintain your funds for 30 days and complete 3 buy trades, you'll be rewarded with half an Nvidia share. And the best part, if you sign up using my link below and deposit that same initial sum of 2,000 Singapore dollars, you'll unlock an exclusive $18 cash coupon plus an additional 6% per annum interest boost. And this brings the total to a 12% per annum interest boost for 90 days. So altogether, you could be looking at up to $160 in sign-up rewards just for getting started. So check out the full details in the description below, and thank you Longbridge for sponsoring this video. So let's take a step back and actually talk about what an economic moat really is. So for a start, there are often 6 commonly cited sources of moat: brand strength, cost advantage, network effect, switching costs, intangible assets, and efficient scale. So let's kickstart the discussion with brand strength. I think the classic example of looking at a company with a strong brand moat, Coca-Cola. These are companies where people aren't just buying a soft drink, they're actually buying into a story, a feeling, or even a habit. And there is even a famous case where people were given a blind taste test between Pepsi and Coke, and the majority actually preferred the taste of Pepsi. But once the labels actually come back on, consumer behaviors still leaned heavily towards Coke itself, and that brand familiarity was powerful enough to override taste alone. Then secondly, there's cost advantage. So this one is a lot more about cost efficiencies. So companies like Walmart or even Costco operate at such a massive scale that they can offer prices only a few competitors can match and still be able to turn a profit. So the more they sell, the cheaper it gets for them, and that cost edge actually becomes harder and harder for anyone else to challenge. Third, you have your network effects. So these are businesses that are much more valuable as more people use them. So Facebook, for example, wasn't necessarily the best quote-unquote social network when it started. But once all your friends and families were on Facebook, you had to be on them too. And the same applies to Amazon's marketplace or payment network systems like Visa and MasterCard. So once the flywheel actually starts spinning, it feeds on itself and the moat becomes a lot stronger. Fourth, there is also switching costs, which are exactly what they sound like. How painful it is for a customer to leave the network. Fifth, some companies actually rely on this idea called intangible assets. And you can think of things like patents, proprietary data, or even regulatory license. So these act like invisible walls that make it legally or even logistically difficult for others to compete. And your pharmaceutical companies are your classic example. And finally, there's what we call efficient scale. So usually they're found in niche markets. And you can think about companies like operating in the utility sector. So the market is just a right size for one major player. And if someone else tries to come in, the unit economics wouldn't make sense and businesses would all fail. So the incumbent stays protected, not because of flash or speed or the value that they provide, but because no one else even want to come into the space in the first place. And now that we have walked through the different types of moats, the next logical question is, are all moats created equal, or are some moats naturally much more durable or more valuable than others? Sure, I think we can try to compare across the 6 categories. But even within that same category, there are different layers and different propositions. So think about the idea of a brand power or brand equity. So is the brand power of Instagram or Facebook of the same standing as that of Snapchat? I think the intuitive answer is probably not. So even though they are all social media platforms, but I think Meta dominates in scale, engagement, and also monetization. So how do we tell which brand mode is stronger? And beyond that, how do we compare modes across different industries? Say for example, is Geico's cost advantage more moaty than Visa's network effect? Or is Amazon's flywheel much more defensible than Coca-Cola's brand name? And here's something I personally wonder. Some of these modes actually sound solid in theory, but actually feels kind of fuzzy in practice. So it brings back to the core question. How should we actually evaluate a company's mode before investing into them? So to help us take a much more layered perspective to this entire investing mode discussion, I want to bring in some ideas from Rob, which is the founder of RV Capital that manages roughly $500 million, and his sharing at the 2024 Value Investor Conference. So he actually broke it down into 5 key ideas, or what he calls moat myths. And his first point, a wide moat isn't necessarily better than a narrow one. What matters more is whether the moat is widening or growing in the right direction. And a business with a fast improving advantage will almost always outpace one that is coasting on its legacy. And all you have to do is to imagine 2 boats. One far ahead but slowing down, and one behind but gaining a lot of speed. And it's the rate of change that matters, not the lead itself. Second, some moats actually strengthen with time, while other moats actually decay. So a cost advantage or network effect might compound as the business scales, but a status brand, a regulatory license, fades over time, or they can be bypassed if the company stops evolving. So even with certain moats, there is a hierarchy, and not all of them are created equal. Third, moats aren't the input, but actually the output. So they don't magically appear on the company's balance sheet. They are built through execution, often slowly, painfully, and behind the scenes. Fourth, management matters not just to protect a moat, but to actively grow or destroy them. So a dishonest or distracted CEO can burn through a legacy moat in no time. But great operators with integrity and vision can build one from scratch. And Berkshire Hathaway is a prime example. It wasn't born with a moat, but Warren Buffett built one through smart capital allocation. And finally, the fifth and the final moat myth. In a fast-moving world like today, moats can actually be a liability. So in dynamic economies, being tied to old advantages like legacy systems and partnerships or entrenched rigid pricing models can actually make a company slow, bloated, and unable to pivot. So now, instead of asking, does this business have a moat? A better question might be, is this moat getting stronger? Does it still matter in today's environment? And is the team behind this moat making it much more durable? And once you start looking at companies through that lens, you'll start to notice another layer of distinction. And this time, I think it's best explained by someone I follow, who writes under the name Webb on his blog, findvalue23.wordpress.com. And he draws a hard line between what he calls legacy moats and reinvestment moats. So a legacy moat is the classic fortress on a hill, and you can think of companies like Coca-Cola or even McDonald's. Each of these companies actually commands enviable margins and it gushes cash. But the far tougher question is, what can they do with that cash tomorrow? And most of the time, the answer is give them back to shareholders. So that makes the stock feels like a glorified bond. They're steady, they're conservative, hard to kill, but unlikely to change your life. And a reinvestment mode, on the other hand, is completely different. I think you can picture the early days of Walmart. So each small town store already enjoyed rock bottom cost. But instead of hoarding onto the profits, they actually plowed them back into creating more new stores with the same high returns. So as their footprint grew, so did the cost advantage, because bigger purchase orders meant lower supplier prices, which funded even lower shelf prices, which pulled in even more customers. And that flywheel actually turned 51 stores in 1972 into more than 10,000 stores today. And the beautiful thing, the earnings multiplied more than 5,000 folds along the way. And you can think of many other companies like Costco or even Meta platforms with their ad network. They are all variations of the same theme. The moat protects the core, while the surplus capital is thrown back into projects that earn equally crazy returns. And once you actually grasp this distinction, the investment landscape suddenly looks less like a checklist, but more like a treasure map. You begin by asking three plain simple questions, which they all happen to start with the same letter, the three R's. First, resilience. Ask yourself, how well can this business defend its current profits? They could come from switching costs, brand loyalty, regulatory licenses, anything that makes it hard for existing customers to leave for their competitors. But to be honest, just because a company has a strong brand or some user lock-in today doesn't mean that it will hold up tomorrow. And some of these so-called advantages are far more fragile than they look. The second R, reinvestment. So when the business actually makes money, what does it do with the cash? So if most of these profits or retained earnings gets paid out as dividends or used to buy back shares, that's often a sign that companies don't have many places to put the money to work. And the third R, runway. So even if a company has reinvestment opportunities today, how long can that continue? And this is really about the size of the market, the scalability of the business model, and how much more room there is to grow. And some businesses, like Amazon, clearly has a long path ahead of them. And this simple three-part lens, resilience, reinvestment, and runway, can help you move beyond just spotting about an economic moat and start thinking more critically about what the moat actually means for your long-term returns. And once you've found a business that you favor, I think the final question is price. What's a fair price to pay for quality? And this is where a lot of investors fall into the trap of what Webb calls error of omission. They focus so much on buying something cheap, low PE, low price to book, low price to sales, and they miss the bigger picture. A great business, compounding at a high rate, will almost always beat a merely cheaper one. And Webb illustrates this with a simple comparison. So one company reinvests 70% of its profits at a 40% return, while the other reinvests just 20% of its profits at a 30% return and pays the rest as dividends. If you were to fast forward 10 years, even if the market gives the quote-unquote expensive company a lower exit multiple, it still delivers a far better returns, purely because earnings grew so much more. So as Charlie Munger said, if a business earns 6% on capital for 40 years, you are likely earn about 6% too, even if you buy it cheap. But if a business earns 18% for decades, you'll do just fine, even if you pay up. And the real challenge, of course, is how many businesses are truly that exceptional that can earn 18% on return for decades to come, and how early can you actually spot them. So to pay tribute to the inspiration behind this video, I also wanted to do something of my own. A set of 5 moat myths that I've come to realize some investors believe to be true. Myth number 1. Good management is actually not a moat. So great leaders are an asset for sure. They can shape culture, they can allocate capital well, and they can guide strategy. But they can't overcome a weak business model. So a moat must come fundamentally from the economics of the business industry and not just from the brilliance of the team running it. Myth number 2. A good product is not a moat itself. So a product can be loved, it can be beautifully designed, even revolutionary. But if it's easy to copy or hard to scale, it's not a moat. And many companies with brilliant products have been steamrolled by those with better distribution, lower cost structure, or stronger ecosystems. And a moat protects the business, not just the product itself. Myth number 3. Operational efficiency isn't a moat. So being efficient is important, sure. It keeps margins healthy and operations lean. But efficiency is a tactic, not a defense. So competitors can also improve their efficiency too. So true moats are structural, where they make it hard for others to even get into the game in the first place, not just harder to win once they get in. Myth number 4. Marketing in and of itself is not a moat. Just because you're good at grabbing attention doesn't mean you'll keep it. And if a company relies just on constant ad spend to keep up their top line growth rate and to stay afloat, then once the advertising dollar dries up, customers might no longer stand behind you because there's no reason to. And lastly, myth number 5. High switching costs is not equivalent to customers loving your product or services. So some companies actually trap users with friction. You have your clunky data exports, your proprietary data formats, or even pricing penalties for leaving them. And that may work in the short term, but it actually breeds resentment, not loyalty. And a real moat makes people want to stay because they want to, not because they need to or they're stuck with you. So with that in mind, I hope this video has helped open your eyes to the world of investing moats, not just as a buzzword, but as a real mental model to think deeper about business quality. And I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.